All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Sam Lau.
Hey, hey.
It's 10 a.m. Pacific time here on September 6th, or I guess slightly past 10 a.m. here. Football season started last night, Sam. Your team is playing tonight, and we got a full slate of games over the weekend. So it felt like with the fantasy football drafts going on, our pool at work, that football season is fall now, even though it's 100 degrees outside.
Oh yeah. I'm actually one of the few times you hear me sound excited about the sports games, Jeff, is when the Packers are playing, especially on opening day. I'm actually sitting here, as you're talking about, sitting here in my David Bakhtiari jersey, even though he's been released this year, but still we'll be cheering on him in his further ventures, and of course the Packers tonight.
Do you happen to have a big piece of foam cheese on your head?
No, it's in the closet ahead of me. It's a foam sombrero, a cheese
Oh,
sombrero. Sorry,
yes.
since we're here in LA representing the Packers.
All right. Why don't we get into the where are we for the week? It was a kind of a busy week.
Yeah, yeah. I mean, it's definitely been a eventful calendar week for the macro front, and we're seeing some of the impact of today's data in the markets across the markets today, as the market's busy digesting some of the Pizza Friday data that we got in. But let's just kick it off with the S&P 500 right now as we stand for the week to date. Pretty tough week. It's down about 4.25%. If my eyes don't deceive me, it's down 1.75% just on the intraday alone for Friday right now. But year to date, it's still up 14.5%. Looking across the board here, it looks like we have one sector in the positive for the week that's up. Consumer staples up 70 basis points. We'll see if utilities started out the day with a positive weekly print. Right now, it's sitting down 15 basis points for the week. Everything else pretty strongly in the red. Leading the way down is technology. That's down almost 8% on the week-to-date basis. Still up 6% on the year-to-date basis, though. So pretty strong underperformance by tech, both on the week-to-date as well as the year-to-date basis, underperforming by a full 8 percentage points thus far in this year-to-date. Looking across since it's such a big move this week, let's take a look at some of these other areas that we look at within the U.S. equity markets. The Russell 1000 also down about 4.25%, matching the S&P 500's return. The Russell 2000 for the small cap names, that's down 5.75% thus far week to date. Growth, Russell 1000 growth is down 5.5%, and Russell 1000 value is down 3%. So a pretty tough week. A lot of that just being contributed from today's intraday performance thus far. A little bit of the other way around, bro, in fixed income land. What we have here for starting out with treasuries is the 2-year note. That's right now at a yield of 3.7%. That's 22 basis points lower in yield from where we ended last Friday. We got the 10-year note that's at a yield of 3.73%. That's in about 18 basis points over the previous Friday's close. And then let's see here for the 30-year bond, we've got 4.02, also in 18 basis points from the close last Friday. So what that means so far for the broad bond market, as measured by the Bloomberg U.S. bond aggregate, that's down about 1.2% week to date. It's up just under 4.5% on the year-to-date basis. Almost a clean sweep for the week-to-date basis. The laggard here is going to be the bank loans, kind of reflecting some of the sentiment that we're seeing there with regards to the short end of the yield curve, as we'll discuss later on as we get to the macro section. But bank loans down right now 20 basis points, still holding on to a pretty strong positive performance year-to-date, up over 5% year-to-date. But the rest of the cohort that we look at within fixed income having a positive return. We'll see if high yield can hold on to it. Right now, it's up about 10 basis points for the week-to-date basis. But leading the way is IG, treasuries, and agency mortgage-backed securities. Those are all up over a percentage point on the week-to-date basis. And then finally, looking over at commodities feeling the brunt of some of this pain here. It's down just about 1.5% on the day so far, down almost 2.5% on the week-to-date basis, which tipped the commodity complex negative on a year-to-date basis of negative 1.5%. And that's being represented by the Bloomberg Commodity Index. WTI crude oil futures dropped below the $70 handle there. It's right now pricing in at $67.50 for a front month futures contract for a barrel of WTI crude oil. That's down a whopping 8% on the week to date basis here. And then looking at it from the year to date, the year to date, it's down just under 6% on the year to date basis there. Gold, surprisingly, actually, it seems it's a little bit of a head scratcher for me. I thought gold would have liked some of the data print that we had today, but gold is down about half a point right now. It's dropped below 2,500 a troy ounce, where it had closed over last week. Right now, it's at $2,493 and some change as the front month contract for gold futures. So with that roundup of the markets, Jeff, why don't you kick us off on what happened in the macro front this week, since we're getting a lot of volatility here in the financial markets.
Yeah, given it was a short week, certainly a lot going on here. We did have the ISM manufacturing on Tuesday. That number came in at 47.2, was estimated to be 47.5, so a slight miss there. Prior print was 46.8. So, a little bit better from last month, but still contraction there, is still below 50. We've been below 50 here in the manufacturing side for 21 of the last 22 months. We did get a pop above 50 at 50.3 in March, but other than that, the manufacturing side continues to be pretty weak here. New orders decreased to 44.6. Exports decreased also. And so by and large, it's not a terrible print for the manufacturing side, but certainly no signs of life there. We'll have to kind of wait and see what happens from there. On Wednesday, we got the much looked at JOLTS job openings number. That came in at 7.67 million, was expected to be 8.1 million. So a little bit of a cooling there in the job openings market. Actually, the prior number was also revised down. That brought the job openings to unemployed ratio down to 107. It was 1.16 prior to the revision from last month. And remember, we were kind of almost at like that 2.0 level, kind of right after COVID. And Powell has said that he kind of wants it to get back to that 1.0 level. So I'd say we're kind of right there in line with that. Though if you look at the chart, the pace of that decline it looks pretty steep, and so it's if you kind of extrapolate that out with this, which is always you always take that with a huge grain of salt. There, it doesn't really look like that number is going to coast into a 1.0 level. Certainly looks like it's going to kind of go below that level, and maybe that's a little bit of the weakness that we've seen in the jobs market, and maybe that's why the Fed is talking about cutting rates. If we kind of scoot over to yesterday on Thursday, jobless claims numbers came in kind of pretty much right in line with the estimates. No big surprises there. We also got the ISM services that came in at 51.5, was expected to be 51.4. Was 51.4 last month, so kind of still expansionary there. As the kind of similar things going on here, where you still have the services being strong and manufacturing weak. We've been below 50 twice this year. So we're back on solid footing here from the services side of things. New orders increased, and I was looking to see the employment number decreased to 50.2. So that's a little bit of a sign of the weakening labor market, but still above 50 there from the employment side of things in the services sector. And then finally today on Pizza Friday, Sam, as you said, the change in the non-farm payrolls, that came in at 142,000. That was expected to be 165. I heard like so-called whisper numbers being around 150. So kind of slightly in line with the whisper numbers, a little bit weaker from the headline numbers. But above the 140 or above the print we got last month, that was revised down also though. The net revision for the past 2 months was a negative 86,000. So really looking at it, still slow down in the jobs market. Though when we look at the unemployment rate, that was a big surprise last month at 4.3%. It declined to 4.2%. Though it was kind of rounding. I saw it was like 4.2. I think it was like 4.256 last month and 4.22 this month. So obviously the rounding makes it seem like it's dropped, and it has dropped very, very, very slightly. So it kind of still looks like Nothing, not much has changed. Still kind of in the slowdown camp, but maybe not as bad as people were expecting after the last month's number. And you kind of saw that there was not too much vol there in the markets this morning when that number came out. Labor force participation was flat at 62.7, and the underemployment rate actually ticked up to 7.9 from 7.8 last month. So continue to see some slowdown in the jobs market. This was the big data point that we were expecting to look at before the Fed meetings on September 18th. So let's take a look over to see what the interest rate probabilities are, and we'll give a live refresh since it's been moving around a lot. Like right after the data came out, it was priced at a 50-50, so 50% chance of a 50 basis point cut on September 18th and a 50% chance of a 25 basis point cut. That number has come down pretty significantly. It's a 29% chance now of a 50 basis point rate cut. So it doesn't seem very likely. It came down a lot on Fed Governor Waller came out and said that, he said that the balance of risks have shifted towards the employment side, as we've been discussing, Sam, and that the current batch of data no longer requires patience, it requires action. So certainly setting the stage there for the Fed to cut rates. And also that, they were talking about there, Waller was open-minded about the size and the pace of rate cuts. Then Nick Timiraos came out and his tweet said, or I guess it's still a tweet, I don't know, whatever it's called. He said the Fed Governor Waller's speech doesn't explicitly say 25 or 50, but leans into endorsing a 25 basis point cut to start, explicitly reserving the option to go faster as appropriate if new data show more deterioration. So I think that's kind of going to be the Fed's plan. They want to slow roll it. They want to do 25, and then they can always up to 50 if there is a higher problem, if they still see deterioration in the labor market. They see signs of recession, then maybe they'll do 50. But right now, they're going to try to say, let's just do 25 basis points as kind of our base case and see how things play out.
Yeah, there's definitely a lot of room there for policy softening, right? I mean, they have some time. Well, we'll see if they have time to adjust the pace, accordingly. But I mean, given where inflation seems to be kind of trending towards, let's call it anywhere from the 2 to 3 handle, right? I mean, they still have somewhere in the neighborhood of 200 to 300 basis points of policy rate moves that they can do to kind of go from a so-called restrictive to something that at least is not necessarily neutral to the economy, but neutral to the pace of inflation, having that real yield that they've always talked about, at least in the beginning of this hiking cycle.
Yeah, and with the idea of maybe a recession being on the horizon and the Fed having to cut more rates, let's move into the topic of the week here. Now that we're past Labor Day, and we're going to talk about yield curve de-inversions, and it's a very timely topic. We kind of switched it last minute here since the 2s10s curve is at a positive 3 basis points as of time of recording. But it's been pretty interesting. Like if you go to the Fred database, the St. Louis Fed has a database. They have a 2s10s. It's a constant maturity index. So maybe that's why it's slightly different from just using on-the-run treasuries. But they show last Thursday it was the 2s10s was flat. Wednesday it actually went positive by a basis point. Then Thursday went back to flat. Then Tuesday it went back to negative 4 basis points. Wednesday positive 1 basis point. Yesterday negative 2. And then today, if things close where they should be, it should be around, a positive 3 basis points. So at least we're actually at a place where it's not just like flat 1 basis point. It's actually, if you want to call 3 basis points a meaningful de-inversion of the curve, then I guess I wouldn't have issue with that. And whether we kind of go or kind of, Sam, why don't we talk about what that means in terms of the de-inversion of the yield curve and the start of the recession?
Yeah. So, as longer term listeners of the minutes have, if those have followed us have heard, Jeff and I have talked about the yield curve and what it means in terms of recessions in some previous episodes. So just giving some foundation for those who are less familiar. If you go back to episode 52 that Jeff and I recorded on February 11th, 2022, we talked about the yield curve and why they could be why they have been a pretty good signal for impending recessions. And then we followed that up about 55 episodes later on March 17th, 2023, where we talked about yield curve steepening and then what that meant in terms of what the timing would be for an impending recession. So we figured today now that we've had a week of, maybe some de-inversions that we have. We'll see if today holds as well, what that will mean in terms of perhaps the timing of the recession. So, if the data that we have, Jeff and I went back to the 80s recession, so the one that first began in January 31st, 1980, and we compared the points on the curve of the 10-year yield relative to both the 2-year and the 3-month yields as kind of the opposite end to get that spread. And the reason why we only go back to the 80s is just because that's where some of the more consistent data comes from, at least what we could get from on the Bloomberg. And the way that we define some of these signals is whenever a signal is reached, let's just say for this point here, when you start to first get a positive yield curve between those 2 points, that has to be in place for 5 consecutive trading days in order for us to consider that a signal. So if we were to take, what Jeff just talked about, you had a few blips here, intra-week, but spaced out by inverted yield curves on Thursday. I believe we had something might have popped up positive on Wednesday, then we had the negative on Thursday, and then today it seems like it may close positive. That doesn't constitute a signal. But let's just say 2 days is the first day of positive yield curve, and we use this as a signal. The way we will determine that is if by the close of next Thursday, between now and then, we have 5 consecutive trading days of positive yield curve spread between the 10-year and the 2-year note that we're looking at right now, then that will constitute today as being the first day of the recession, or sorry, of the signal, to be clear. So with that, what we've looked at going back to these recessions during that period of time, beginning with the January 1980 recession, there has been 6 periods that we can look at recession that kind of back-to-back recessions of 1980 and 1981. Some people don't even split that up. They call that one recession. The NBER, the National Bureau of Economic Research, who's the official scorekeeper for recessions, considers that too. And then again, 1990, we had one in 2001, 2007, and then in 2000, a very short-lived one that, we could excuse listeners for forgetting, but we did have a recession that began in February 29th of 2020 and ended 2 months later on April 30th of 2020. So that's kind of the backdated data that we're looking at to kind of derive some information, see if we can derive some information as to when, how we can think about the next recession that's coming forward. So within that component of time, it looks like, again, up here we're looking at the differential between the 10-year yield relative to the 2-year. There were 2 periods of time where once the signal was struck that the curve had de-inverted, there was in the 80s, the two 1980 and 1981 recessions. Those recessions actually took place prior to the yield curve going, the spread being positive between those 2 points. For the remaining 4, if you take a look at that, on average, it was about 5 months before that positive signal was struck before the subsequent recession. That actually equates out to, let's see here, 151 trading days if we were just do it from calendar date to calendar date. So with that in mind, what that could portend is that if we look at it with the average of those 4 recessions that had recession start dates after the positive signal was struck, then we could be looking at somewhere in February 2025 of a possible start date for the recession on using the average of the 4. If we look at the maximum number of months from positive date to recession being struck by the NBER was 7 months or 208 trading days. That would put us in the month of April as the potential start date for being declared by the NBER. And then, of course, if we were to think about it from a standpoint of maybe the recession already began, there's some high-profile pundits out there that claim that, or that believe that the recession has already begun, maybe as early as October of last year. So if that's a consideration there in terms of using history as a guide, then what the simple model that we look at here, that would point to a recession having begun in May 31st of 2024 here, based on what we've seen, because the earliest recession that we've had in that period of time is 3 months prior to that. A recession being declared 3 months prior to that positive signal day being struck. So a whole host of range of options, to think about in terms of what we have seen historically with regards to what signals the yield curve provides relative to the beginning date of recession. Kind of what we're looking at here, I guess, just to highlight again the key numbers. Perhaps it started somewhere around the end of May of 2024 of this year. Perhaps we could be looking at something as a max of maybe April of 2025. If we just try to nail it in the average, then it's at the February of 2025 is when we can start thinking about it from recession period. But this is something that we'll continue to track. Again, we'll be looking for a de-inverted curve on the close as of today. And if it continues each day through Thursday, then we can consider today to be that start date. And you would have heard it here first on DoubleLine Minutes.
And when we do look at, when we use this obviously as one of the signals as a recession indicator. So, obviously the ISM manufacturing numbers are probably still saying recessionary. The leading economic index has been saying recession for 2+ years now. So it's really a case of we use this as another indicator. And so if this does stay positive, Sam, as you said, for 5 business days here, so next Thursday we'll know. So I guess next week we can talk about it, whether we are on recession watch or we're out of the woods again.
Yeah, maybe if you got a line into Jerome Powell, you can let them know ahead of their FOMC meeting the following week as well.
Yeah, because I forgot to mention that it is the Fed blackout period now, so we won't get any more Fed speak. So if they want to indicate 25 or 50, then you should listen to see what Nick Timrose says, because he'll be leaking that information if there is anything to leak.
Yeah, it is interesting too, because you and I kind of joked around in the early parts of this cycle that we're bound to hear the "this time is different" type of arguments that always seem to come around whenever the yield curve inverts and then goes through the cycle, and then you have the subsequent recession. We certainly heard the chorus of that going around. Seems like that chorus has a little bit. What's the word? I don't know the musical term here, but it's a little bit less strong. It's a little bit less powerful nowadays, as we're starting to see some of the perhaps a slowdown in the labor force. So we'll see if this time is truly different or not. But as of right now, it has been the longest days in terms of the longest window of time of having an inverted yield curve. Right now, if today is the start date, then we've had 794 days of inversion beginning on July 5th of 2022 for this current period. The last period of time where the second longest period was in that January 1980 recession, where it was 624 days inverted. So we're definitely pushing the parameters there. So perhaps this time is a little bit different, but we shall see, as we like to say.
Yeah, but it is the yield curve de-inversion that's the recession signal, not the yield curve inversion.
Correct.
But of course, you have to be inverted to get de-inverted. So that's obviously now we know, like, you can be inverted for 26 months before, and maybe no recession, or at least a couple of years before a recession. And with all these things, as you said, Sam, there's only like six sample sizes, so it's hard to draw definitive conclusions from this. Whether it's 5 months or 11 months, or 7 months, you never really know what that is, or we can always expand it. But it's usually a good signal that recession coming at some point.
Yep. We'll certainly be keeping watch here.
All right. With that, let's move on to things to keep an eye on for next week. And really, there's 2 days to really worry about here, and it's inflation week next week. Fed seems to be shifting towards the labor market side of things, not worried about inflation. But if we do see a significant pop in inflation, obviously that would that would decrease the chance of a 50 basis point rate cut and increase the chance of only 25. On Wednesday, we do get CPI. The month-over-month number for August is expected to be at 0.2, exactly the same as prior. Core CPI at 0.2, also exactly the same as prior. That would bring the year-over-year CPI to 2.6, down from 2.9 from last month. That would actually bring core CPI flat still, though, at 3.2. So, looking at the CPI, doesn't really seem this month doesn't seem like it's one where you're going to see some positive momentum to inflation coming down if things come out as expected. If we get a 0.1 or or a flat number, then you'll see those year over year numbers come down, and that maybe give the Fed a little bit more of confidence that they could hike 50. We do get PPI on Thursday. PPI final demand month over month expected to be 0.2, up from 0.1 last month. Ex food and energy PPI, like similar story, 0.2, up 0.1 from last month. That bring year over year PPI to 1.8, down from 2.2, and ex food and energy 2.4. And obviously on Thursday also we have jobless claims. Initial jobless claims expected to be 230,000 versus 227 last week. And continuing claims are 1.84 million. And I was listening to the Channel 11 video that Ken Shinoda hosts. I had Jeff Sherman on, and Sherman did say that he always likes to look at the jobless claims numbers as another early indicator of labor market weakness because when people lose their jobs, they apply for the unemployment, and that's where you'll see it here. So that could give you a good indicator, a good early indicator of more labor market weakness, but we have yet to see that in those jobless claims numbers as we talk about every week here, Sam.
Yeah, so a pretty big week next week in terms of market moving data and perhaps rate moving data in terms of the target rate. That's pretty much the last inflation series of inflation print before that September 18th meeting. Today was a big Pizza Friday jobs and on the household and establishment data. So two of the big ones are done. I think the only thing just scanning kind of the page for what lies between what you mentioned and then the 9/18 meeting is the day before we've got the retail sales data. So just perhaps a little indication of the U.S. consumer strength there, but pretty much there. I mean, the clock's winding down on this what looks to be the first move in rate policy in some time.
And if the Fed can engineer this soft landing with a few 25 basis point rate cuts, then that'll be the game plan going forward.
Yeah, that's the high bar to shoot for.
Yep. All right, with that, I think that wraps it up today. I'd like to thank everyone for listening at our, I guess, new time, but also the old time.
Yeah. Thanks everyone for checking us out today on DL Minutes. Don't forget, you can shoot us your comments, questions, and suggestions on the X at DLine Minutes. We'll commence. As you see, we've started again with our topic of the week. We do have a number of questions that came over the last few weeks that we'll start hitting up in the coming weeks.
Yep. And don't forget our website is doubleline.com. The YouTube channel is youtube.com/doubleline capital. As I mentioned, the most recent episode of Channel 11 is up there. It's titled "The Rate Cuts Are Coming." And if you know anything about Ken Shinoda, you know that he loves these funny graphics. And so the very first chart they put up is very amusing. So tune in just for that, for a good laugh there. Thanks for tuning in, and hope everyone has a great weekend.
All right, thanks everyone, and good luck out there.